We got the data from Marcus Millichap, and look who's here. Hey, listen, it's really great to have you back. You always give us so much insight in the commercial real estate market. So
Thank you, Frank. Great to see you.
All right, so I do have to say, your data says that a lot of these borrowers are expecting to get some relief. I'm looking at some articles in the Journal. I'm looking at some other articles about $2.2 trillion in loans. They're coming up and they're due in 2027. And a lot of reports say that those rate cuts are coming just too late. What are you seeing that's different?
The most constructive part of the rate cut is that it will spur more transaction activity. The market is resetting prices as we speak. Prices are down anywhere from 20 to 35%, depending on the property type. Office buildings, of course, have taken the biggest hit on valuations. As these prices have recalibrated according to the free market, the lower interest rates allows people to do transactions again, which takes a lot of these loans off the books of the banks and other lenders. Mm-hmm. That natural flow of capital, which was disrupted 2 years ago, itself will help the market more than anything else. As far as lenders are concerned, it is not in their best interest to market today and sell some of these maturing loans at a deep discount, except if there are obsolete office buildings that are very unlikely to make a recovery. So they're making calculated decisions on what to fire sale and what not to fire sale.
All right, well, to that point, I'm looking at this Journal article that just came out recently. CRE loans in foreclosure this year tripling to over $19 billion. How does just one rate cut at 50 basis points, how does it stop that trend? That seems like kind of a snowball.
It is, and one rate cut is not the magic wand of solving this problem. It's 2-3 years of patience by lenders, giving the market time to recalibrate. This is what we saw in 08-09, where the avalanche of underperforming properties was significantly higher than what we're seeing today. But we didn't see the similar situation that we'd seen in the early 90s, where there was an entire organization created by the government, RTC, to literally fire sale underperforming commercial real estate at the time. That has not been repeated. I don't believe it'll ever be repeated because it's a systemic risk to the entire credit markets.
So you admit we're kind of in a downward snowball, but you're saying it's not as bad as it could have been if we didn't get that 50 basis point cut.
Well, the 50 basis point cut, Frank, is the beginning of a trend. Of a trend.
Right. But that's not going to stop some of the people who are under pressure right now with those loans coming up. I just mentioned $2.2 trillion.
Yes.
That's not, a lot of people won't be saved. You mentioned obsolete, probably urban buildings, or yes, probably in that case. Right. Probably some older multifamilies, things that aren't as attractive as they maybe once were. I want to move on to some of your other data looking forward, if you don't mind. We're actually just showing it. CRE lending to increase year over year, actually over the next 2 years. So this year, $539 billion. Next year, $665 billion. That's a huge jump. What's the catalyst for that jump?
The catalyst is the pent-up demand that's been created by a lot of sellers who've been waiting out this downturn. They didn't think they can get fair market value. Operations on properties, for the most part, have been healthy because the economy's done well. To remember, our business is tied so much to job creation, and job growth has been fairly strong. And as it slows, it's expected to remain positive. Put on top of that the fact that the new construction starts in every property type have pulled back significantly, including multifamily, which saw a record amount of new properties, new units being delivered in 2024, pulling back by somewhere around 20 to 40%. So the supply side is adjusting. Demand looks pretty good. Capital markets are normalizing. Prices have reset. And record capital on the sideline, you were talking about sideline on your previous segment, right. Sideline capital is coming back into the market. We're already seeing it.
All right, we got to go, but is it going to come into industrial, multifamily? Because you're saying it's a pullback in multifamily. So where does this money go to when it comes to the loans?
Shopping centers are the #1 sought after property type. Multifamily, really? Absolutely, because they have gone through 15 years of reimagination on the retail side because of e-commerce, followed by multifamily, believe it or not. Remember, multifamily occupancies are 95%, 94%.
Hessam, we got to go.